Happy Friday, everybody. Good afternoon, all you magnificent melon heads of the world, and happy Friday, everyone. It's my favorite time of the week, my weekly wrap-up live stream, and it's been a pretty crazy week. Well, I don't know about crazy week. It's been a pretty bullish week. It's been a pretty dovish week. The bull and the dove. All right, trading this week has been dominated by dovish Fed sentiment, driving market participants to just salivate, frothing at the mouth. Oh, Zerpenberg's coming back any day now. I can just feel it. We had that dovish Fed press conference. What was that, May 1st, when JPow went up there, and despite releasing very hawkish statements, he comes in and he says, oh, no, we're going to cut QT virtually in half. Very dovish action. And then we had a jobs report came a few days after that, and it showed slowing job growth, and the market celebrated because a weak jobs market is a good thing up until a point. We'll get to that in a little bit. And then came on early this week, and then I believe was it Thursday? Was it yesterday that we got that initial jobless claims, that big spike of about 10% in initial jobless claims? And once again, the market celebrated a weak jobs market. So good for the market, so good for stocks, right? Who cares if nobody can afford to buy anything anybody's selling because Zerpenberg, because it doesn't matter if nobody's working and nobody is earning and nobody's spending. Have you heard how many GPUs Facebook bought? That is the stupidity that passes for our current market. And that sentiment was dominating this week up until 10 a.m. this morning. 10 a.m. this morning came the Michigan Consumer Sentiment Survey from the University of Michigan. And along with that came consumer sentiment, came inflation expectations. And we got to set the table for this one because Jerome Powell at the last FOMC press conference, he made this kind of flippant, dismissive remark when he was asked a question about stagflation. Let me play the clip for you now.
I don't see the stag or the inflation, actually.
I don't see the stag or the inflation. And then, of course, all the financial press corps at the Federal Reserve, they all start giggling like the sycophants and the children that they are. JPow, you're so funny. The soft landing, we all know the soft landing is guaranteed to happen, right? And then, of course, along comes the University of Michigan Consumer Sentiment Survey today. And, well, apparently the average person on the street doesn't think it's so funny or at all, because consumer sentiment dropped substantially to 67.4 in this latest reading. That is versus an estimate of 76. That is a huge miss on consumer sentiment. Obviously, the average person can see the stag and can see the inflation. The average person understands it. Or maybe the problem's just those bad economic vibes. I hear so much about those bad vibes. Maybe if Jack would just shut up and be positive, the average person would understand how lucky they are to have the Fed making decisions for them. Maybe it's just bad vibes. Maybe that's why the consumer sentiment came at 67.4 versus estimates of 76. By the way, that's down from 77.2 in April. Whoops, that's the biggest, that is the lowest since what, November? That is a very big drop. The average consumer not feeling so good right now, not feeling very good about the state of the economy. Now, how do you rectify that with all these statements about the resilient consumer and the American is still spending and everything is so good and the soft landing? So what's what? Why are people so negative if all the people who tell you what to think are saying things are so good? What gives here? Well, maybe it's the fact that all of this consumer spending is just debt fueled, both credit card and point of sale financing, things like buy now, pay later debt, something I've been banging the table on this channel for a while now. That buy now, pay later is a big cancerous growth in the economy that is going undetected. And early detection is always the key to solving problems like that. Well, we're just going to ignore that problem until it's huge. So maybe that's why the consumer sentiment is so low. Yeah, he's still spending. He has no choice. He's trying to maintain his quality of life, but he's racking up debt doing it, debt he can't afford to service. And maybe that's why he's so down in the dumps. Maybe that's where the bad vibes are coming from. So there's the stag in Jerome Powell's comment. Again, here's Powell's comment.
I don't see the stag or the inflation, actually.
Well, the Michigan Consumer Sentiment Survey sees the stag. All right, the consumer is very downbeat. And remember, guys, the consumer spending is about 70% of GDP. So if the consumer is down in the dumps, the economy will follow. Now, on top of that, let's talk about the inflation that JPow can't see, because also included in that University of Michigan sentiment today was the one-year inflation outlook, and that was 3.5%. And that's up from 3.2% in April, and that's also the highest level since November. So not only is the average person down in the dumps about their financial situation, they also think inflation is coming back. Oh, and by the way, the average person is right. Inflation has been coming back. We've had 3 consecutive higher CPIs and PCEs. We get another one next week. That's going to be an important one. We hear so much about this fall in rents, that CPI rent is going to start falling any day now. Still hasn't happened. Is it going to happen soon? Maybe it happens this time around. We won't know until next week. Also, we got the 5-year inflation expectations. That one came in at 3.1%. That's up from 3.0. Not a huge increase, but it is the highest since November, much like the 1-year inflation expectations. So there's your inflation also. Now, guys, just a quick reminder, stagflation. Stagflation is loosely defined as periods of low economic growth, usually accompanied by high unemployment with simultaneously high inflation. The two are usually not accompanying one another. It's basically the worst of both worlds when you get high unemployment, low economic growth combined with high inflation. It's misery. It's the 1970s is what it is. And by the way, if we still have 3% inflation, and if we still have stocks at all-time highs and housing at all-time highs, and the Fed decides to start cutting rates, you better believe we're going to get higher inflation. And, well, unemployment is already trending higher. Ever so slowly, it's taking its sweet time getting there. But it's entirely plausible that we see this stagflation develop. Now, again, we still don't have actual stagflation. I want to be very clear about that. We don't have it yet. All right. And I think that was the root of Jerome Powell's comment. Right. Everybody's zeroing in on the joke. If you go back and you listen to everything that he said before he made that joke, he actually makes a pretty good case for why we don't have stagflation right now. The economy is still growing, right? The last GDP number was about 3%. So that's pretty good economic growth. Now, that's overlooking the fact that all of that growth is government deficit spending. Take away government deficits and there ain't no GDP, none at all, right? Things like the CHIPS Act, the Inflation Reduction Act, these ridiculously high deficits, right? That's all of that economic growth is being fueled by government debt, right? And if you see how that's worked out in the electric vehicle space, well, stagflation, you can see how we might eventually get there. And on top of that, inflation, we still have relatively low inflation, right? 3% is elevated based on what we've seen in the last 20 years or so, but it's obviously way down from the peak of 9% that we saw in 2020. Was it 22? August of 22, I think we peaked, or June of 22, we peaked at 9.1%. So inflation has come down and GDP growth is still solid. So I want to emphasize, we don't yet have stagflation, but we are trending in a stagflationary direction. Unemployment is rising and inflation is rising along with it. And right now, the Fed, who was tragically incorrect about transitory, is saying,
I don't see the stag or the inflation, actually.
Let's hope that doesn't turn into the new transitory. All right. And we're going to zero in a little bit on that. We're going to look at some of the trends that came in with that University of Michigan sentiment survey today. Also coming out today, the Fed released their semi-annual report, and they are raising a red flag about rising delinquencies in commercial real estate, something that if you've been watching this channel, you can see that one coming. And they also made reference to New York Community Bank in this report in Bloomberg about this Fed raising awareness of CRE delinquencies on the rise. And there's been some recent developments in New York around their rent controls that tells me the problems at New York Community Bank are probably not over. It's probably going to take more than $1 billion to save that bank. There's also problems going on in Japan. The yen continues to weaken after last week when the Japanese finance ministry intervened and started dumping dollars to try to prop up the value of the yen. Well, it worked for a short time, but the yen is falling again today. And BOJ Governor Ueda came out and tried to jawbone the yen higher against the dollar, and he failed miserably. The yen is still falling. So pay attention to what's going on in Japan. And by the way, talking about Japan, SoftBank very unceremoniously delayed their earnings report by a week. SoftBank was supposed to report, I think, yesterday or Wednesday this week, and they delayed the announcement by a week. There's no explanation offered for that. Virtually no press coverage of it. The only reason I even know about it is because I follow some people on X who follow SoftBank very closely. But SoftBank is one of those big NASDAQ whales that's been propping up tech stocks with ridiculous gamma squeezes and options trading. They're also notoriously exposed to foreign exchange weakness that they haven't properly hedged against the declining yen. And so when SoftBank comes out and delays their earnings and everybody ignores it and says, now just go buy AI stocks, pay attention to that one. SoftBank reports next week. I'm not sure what's coming out of that, but that one, there might be some fireworks around that. Oh, and TD Bank, one of Canada's biggest banks, Toronto Dominion Bank, they're going to be fined $2 billion for, this little story about they helped launder hundreds of millions of dollars of Chinese fentanyl money. Probably nothing you'd be interested in, I mean, as long as they're divesting from their oil and gas investments for their ESG, who cares if they're pumping hundreds of millions of dollars of fentanyl into the U.S., killing hundreds of thousands of people? Yeah, it's really just technical stuff that you guys wouldn't be interested in. A lot going on in the world today, guys. Why don't we shrink my big melon of a head? Let's say hi to my man, Mish the Mod, who is coming to us live from Romania. How's it going, Mish?
Pretty good. It's Bucharest, Romania. I'm actually going to go see Castle Vlad's Castle tomorrow. It's funny. Everyone, what's that?
Vlad Dracula, if you will. Dracula's castle.
Yeah. So everyone, when they think of it, thinks the castle's in Braun, which is like the famous movie castle. But I'm actually going to go see the real one in Wallachia. It's kind of run down, but so I'm going to see both tomorrow.
Okay. And you've been there for a couple of days now. What's your overall take on the state of economics in Romania, say, compared to some of the other countries that you've seen in South America and Asia on this trip that you've been on?
Actually, Romania is doing a lot better than most countries that I've been to. I am in a little insular area here. I'm in we would call it a town market in the United States, but it's like the restaurants are here, all the grocery stores surrounded by apartments. You really don't have to leave the area. So I will see more of it tomorrow when I go downtown.
All right. Well, and just again, for the record, you're not working for the CIA, right? And you're not you're not traveling around Europe fomenting rebellion or anything like that on behalf of the company.
Little side gigs here and there.
Yeah, we do what we must. Times are tough. All right, let's go through the markets, everybody, shall we? The S&P is still in
far into it. I wanted to add that what scares me about the inflation is the gold and silver prices, because the gold's at near all-time high. I got it, not correct for inflation, but and silver is higher than it has been. And if you look back in history, every time that gold and silver get really high, it's followed by inflation within a year. So if we have gold and silver really high, then they start lowering rates into inflation. So then you have the high metal prices, you got lowering rates and high inflation. It just becomes a mess, and they'll never catch up.
And gold and silver, I think, have been sniffing that out, and that's why that stealth rally in gold and silver that started late last year and early this year, and nobody really paid close attention to it until like February, March timeframe. And by then we were almost back to all-time highs in gold. And, we sold off a little bit in metals through, mid to late April. And now it looks like it's gaining steam again. Well, we're going to get to metals in a minute here, but that 28.30 level in silver, man, it's mocking me.
In 2021 in that summer, the little tick started happening way back then, gaining momentum before anybody started paying attention to it.
Yeah, all through the late spring, early summer of 2020 was really the big move in metals. We had the silver squeeze move in February, January of 2021. That was obviously kind of an isolated incident, but all through the first half of 2020, gold and silver did very well. The inflation didn't actually show up until a year later. So you're right. It does better ahead of the inflation, not during the inflation. All right, let's get back in through the market, shall we? The S&P is up 8 points, 0.14% higher today, just clinging to positive territory. I want to point out here, guys, we had one heck of an open. We were looking pretty good, and then 10.00 came out. You see this red candle and this sell-off from 10 o'clock to about 10:45? That was all the market's reaction to that Michigan consumer sentiment survey. That was enough to move markets, and we really haven't budged much one way or another since that sell-off. So that was really the driving force in markets today, was that Michigan survey. And I just want to show you an important thing here in the S&P. Last week when we talked on this stream, we had pointed out that we were right at the 50-day moving average and that this was going to be an important technical week. Well, we were up almost all week. We blew right through the 50-day moving average. Now we're getting pretty close to the all-time highs again up here around, 52.60 or so. But we did get that little bit of a sell-off now. We'll see how we do in this last half hour of trading or so. But the market is kind of stalling here near the prior highs. And it's going to take probably a low inflation print next week, clearing the way for the Fed to bring back Zerpenber to move stocks higher here. So I think that's probably going to make or break whether this rally has any steam or not. It's going to be next week with CPI, which CPI is, when is that next week? It's, I think it's Thursday. This is a weird week. Like we get PCE before we get, not PCE, we get PPI before we get CPI next week. That's unusual. We don't usually get it in that order. The Dow is up 130. Yeah. Go ahead, Mish. I'm sorry.
Hold on, I'll look it up for you.
Okay. The Dow is up 135. Yeah, go ahead. Look, just shout out, jump in when you have it. Dow's up 135, about a third of 1%. Again, we had a big move at the open and then a little bit of a red candle around 10 o'clock. Not too much in the Dow. Long-term chart in the Dow, these are daily candles. Also looking about the same. We broke through the 50-day moving average on the Dow, moving up higher pretty much all week. Again, within striking distance of the all-time high. And the NASDAQ is actually in negative territory. The NASDAQ traded the worst out of all the indexes on that Michigan consumer report there, selling off a lot harder, actually went into negative territory. And it's been sitting right about there pretty much all day. And the NASDAQ on the long-term chart, again, kind of the same thing. We recaptured that 50-day moving average, moved higher for most of the week, and now we're stalling out here right around the all-time high levels. So CPI next week is going to be the big driver there. Mish, did you have that
PPI
date yet?
On the 4th. Yeah, PPI is on the 14th and CPI is on the 15th.
Okay, so we're going to get PPI before CPI this week. And you said the 14th and the 15th?
Yeah, so was that Tuesday and Wednesday, I think?
Yep, Tuesday and Wednesday, PPI and CPI. All right, we'll keep an eye on that one. And by the way, Cole Marsh is saying let's get Mish a little bit of garlic, or a little Gallic, as they say. A little garlic, just in case. Maybe wear a little bit of that around your shoulders there. You know, some holy water.
So, yeah, put it next to my jade necklace.
You froze up a little bit. Are you holding up the crucifix there, Mish? Or are you?
Yeah, no, I was going to say you can put it next to my jade necklace.
Okay, there we go. Hey, you know, better safe, better to have it and not need it, right? Thank you, Cole Marsh. I appreciate that. And what happened to my comments here? Oh, thank you, Vanny. That one skipped by me. He says Kayla Scanlon has the worst take on the vibe session. I've followed Kayla Scanlon before. I used to enjoy her work, and then she started doing a lot of work with the Bloomberg crew and some of the other millennials on Bloomberg, and she really drank the transitory Kool-Aid and really just started towing the party line of the establishment financial press. And, you know, hey, I guess everybody has their number. Let's just put it that way. But yes, I do believe Kayla Scanlon patented the phrase vibe session. She's the one that's trying to say, oh, the problem is you know, don't worry. All these Bloomberg people I hang out with say everything is great, even though I, you know, haven't touched grass in a freaking year, but I'm sure everything's just fine in flyover country because the people at Bloomberg tell me so. And, you know, by the way, that's one of the reasons all you guys, like a lot of people have been sending me messages and things and sending me stuff like their story, what their business is seeing. And a lot of people apologize for long emails. Never apologize for sending me messages or telling your story in a message or an email. I read as many of them as I can. I don't read all of them. But I'm telling you, these stories in aggregate, when I hear what people are seeing and what's happening in their particular industry, it kind of keeps you grounded. When you live all day in media reports and these reports from the Fed, you can get disconnected from what's actually going on in people's lives. And so this mosaic, the anecdata that I get from everybody, it really does help keep some of that in check. And if I get an email with a message that says, hey, my business is doing really great in this industry, and it flies in the face of something your report from the Bureau of Muckety Muck says, well, then I go seek an explanation. What explains this deviation here? Maybe the report is wrong, and there's content ideas hiding in there. So, all you guys, thank you, all you folks who send me these messages with this information. It really does help, and I think it makes the channel better. And it keeps me from saying stupid things like bad vibes is why everybody's so down on the economy. Not because the economy sucks, not because life got more expensive and wages didn't rise, right? So thank you to all those people who send me those messages. And I share the sentiment there, Vanny. Thank you, sir. All right, let's move on a little bit here to the DXY. The US dollar is a little bit stronger here, about 5 basis points higher. Now, the dollar did the opposite of what we saw in stocks. We saw the dollar was weakening this morning at the open, and then 10 o'clock came around and came that Michigan Consumer Sentiment Survey, and look at how the dollar strengthened on that. That was the market starting to give back some of that dovish enthusiasm about the Fed, although you can see that wane through the course of the day, and we're pretty much right back where we started the day. So not a big move in the dollar here. And bonds also moved higher on the news of that Michigan survey result. We got the 30-year, it's 4.646, up 4.5 basis points. The 10-year, 4.505, up almost 6 points, back above 4.5 for the 10-year. The 2-year yield, meanwhile, 4.868, that's up 6 points. And the 1 month is at 5.386, where it's pretty much been held there by the Fed's overnight rate. Looking over at commodities, we have got gold is having a hell of a day, up 1.3% for June gold futures at 2,370. Spot gold is at 23.63 off the highs of the day. We did see 23.78 at one point, but still up 17 bucks. We got July silver futures at 28.47. That's up about a dime or a third of 1%. And spot silver at 28.22. That's actually down 10 cents for spot. So let's look at a couple of these charts. First, let's look at the silver chart. And guys, I was so excited this morning on my 9 a.m. live stream because we were above that critical 28.30 level. And me and my big mouth, I had to jinx it. I apologize. I blame myself. It was me. I ruined the rally in silver, guys, because shortly after I wrapped up my stream, we got that Michigan Consumer Sentiment Survey, and silver puked on that note, on that news. I guess, this is silver saying, hey, maybe the rate cuts don't get here as soon because of what the University of Michigan just said. And so, we're not going to get our lower interest rates. I'm going to sell off a little bit because silver likes lower interest rates. And ever since then, we lost that 28.30 level. These are 1 minute candles, by the way, that we're looking at. We came back up. We just touched that level, failed there. So I mentioned on my morning live stream that I want to see us retest that 28.30 level and move higher. Well, we retested it today and we failed that retest. So I got to dampen my enthusiasm from this morning, but I do think that east-west arbitrage trade is still very much alive and well, and that's going to be driving metal prices higher from here. It just might take a little longer to get there. The gold chart, meanwhile, looking pretty good here. We're looking at 1 hour candles on gold here, and the point I wanted to make was around 10 a.m. today, we got a pretty big red candle here. That was that Michigan Consumer Sentiment Survey, so that took us to the lows of the day. We did bounce off that level, but still gold is not quite at our all-time highs. Let's set this to 1 day candles. What was the all-time high we hit in gold was about 23.90. It looks like was the intraday closing high. So we're still about 30 bucks off that level here. Haven't broken out above that. Be looking for a challenge of that level next week off that CPI report, but we'll see what happens. And also, Bitcoin made a very strong reaction to that Michigan survey today. Check out this red candle at 10 a.m. here. A lot of people dumping Bitcoin on that news. And Mish and I were talking about this before we went live. He's saying, wow, why would Bitcoin react like that to the Michigan survey? And the thing about Bitcoin is lately it's been trading more like a tech stock, more like the NASDAQ than it has been trading like a precious metal or an inflation hedge. And it really didn't like that. Moved back below that support level around 61,100. We've stayed below it ever since. Currently at 6,643, down about $2,400 today. So Bitcoin did not like that report from the University of Michigan. And let's see. Let's get to the big story, though. That Michigan story. Just as soon as my computer starts cooperating, consumer sentiment tumbles as inflation fears surge, closely watched survey shows. All right, this, the University of Michigan survey, it's a very closely watched survey, as they're showing, unless it does something that the Fed doesn't want it to do. And then the Fed says, we're not so worried about that survey. So this is one of those, hey, when it agrees with me, I shine a big light on it. When it doesn't, I ignore it completely. So don't expect the Fed to address this or talk about it at all. But consumer sentiment slumped as inflation expectations rose despite otherwise strong signals in the economy, according to a closely watched survey released on Friday. The University of Michigan Survey of Consumer Sentiment Index for May posted an initial reading of 67.4 for the month, down from 77.2 in April, and well off the Dow Jones consensus call for 76. So this was a huge whiff, a big decline. The market was forecasting a little decline, but it ended up being a big one. The move represented a one-month decline of 12.7%. Although it's worth pointing out that year over year, we're still up 14.2%. So the average consumer is still feeling better than he did a year ago, probably because inflation has come down substantially versus a year ago, although prices are still higher than they were a year ago, but the rate of change of prices has slowed. Along with the downbeat sentiment measure, the outlook for inflation across the 1 and 5 year horizons also increased. The 1 year outlook jumped to 3.5%. That's up 0.3 percentage points from a month ago to the highest level since November. And also the 5 year outlook rose to 3.1%, an increase of just 0.1 percentage points, but reversing a trend of lower readings in the past few months, also the highest seen since November. So inflation expectations, the highest we've seen in 6 months. The sentiment taking a big drop. And then this quote here from Joanne Su, the survey's director, says, while consumers had been reserving judgment for the past few months, they now perceive negative developments on a number of dimensions. They expressed worries that inflation, unemployment, and interest rates may all be moving in an unfavorable direction in the year ahead. And folks, right there, that is your stag, and that is your inflation. Right in that one sentence there, consumers expressed worries that inflation, unemployment, and interest rates may all be moving in an unfavorable direction. So they're talking about inflation heading higher, unemployment heading higher, and interest rates heading higher. Worries of interest rates heading higher. We're all in the tree in the nest with the Fed over here talking about cuts. The average consumer is worried about interest rates going higher. Remember, guys, the Fed doesn't control the long end of the yield curve. The Fed only controls that overnight rate. The long end of the yield curve does what it wants based on supply and demand for those treasury bonds. And interest rates on cars, interest rates on mortgages, business loans, it's all based on what happens at the long end of the curve, not what the Fed does with that overnight rate. So the average consumer is actually more worried about those rates moving higher. And look, guys, if inflation does continue moving higher, if inflation expectations come to fruition and those prices start resuming their upward march, you're going to see higher interest rates on the long end of the yield curve, regardless of what the Fed does. Because if inflation is moving higher, then bond investors are going to demand a higher interest rates in exchange for lending money to the government, because by the time the government pays them back, that money will be worth a lot less. So there's your stag and there's your inflation right there. Those consumers are very worried about that. And we got some more talk about that in this article from Bloomberg. The S&P 500 runs out of steam. That's kind of strong language there, especially when we're right about to touch those all-time highs again. The market runs out of steam here. That would be a double top pattern, very bad technical indicator amid stagflation chatter. And I guess you can include this live stream amid that stagflation chatter, because that's exactly what we're talking about. And I just want to read you a quote from this article. Although inflation data has overshadowed most other reports this year, it's important to remember that consumer spending is the main pillar that has been holding up the economy, according to Chris Zaccarelli, an independent advisor at Alliance. Today's lower than expected consumer sentiment numbers are a warning sign that the consumer shouldn't be taken for granted, he noted. In addition, inflation expectations have been rising as well, which is a double whammy for the Fed. Low consumer sentiment, rising inflation, the worst of both worlds, your stag and your inflation there. Zaccarelli also noted that if spending slows down and inflation increases, we'll get the opposite of the Goldilocks scenario that many were hoping for, and the Fed will be in an especially difficult position of choosing between accommodating a slowing economy and fighting increasing inflation expectations. And that last statement there, let's be honest, that's not really that difficult of a position. If faced with the prospect of choosing between rising inflation and a crumbling economy, i.e., a falling stock market, we all know the Fed is going to choose asset prices. We know the Fed will choose to inflate every single time. See also March of last year and the bank term funding program. See also 2020. See also 2018. See also, what was it? Repo Madness, September of 2019. See also the great financial crisis, or the GFC, the global financial crisis. See also the dot-com bubble. Every time the Fed will choose to stoke inflation and send asset prices higher. Every time. As soon as I see them choose otherwise, I'll be happy to point it out. But, 2022, the one exception, and at that point they acted way too late. And hey, that's also the overreaction in 2022 is what led to the bank failures in 2023, which is what caused them to start printing money again. Let's just look a little bit at the actual data itself. Now, this is the Michigan Consumer Sentiment Survey, and this is showing a 5-year chart of what that survey has done. Now, I want to point out we did see a big decline here, all right? This is the decline that we just got. Big miss, 67.4. Now, let's also walk back some of the enthusiasm here. You can see that this chart clearly turned the trend in June of 2022 and started moving higher. We've made higher lows and higher highs consistently since then. And this big decline that we just saw, it's still within the band that we've been seeing. So if this follows some of the prior cycles, we would see this turn upward very soon. Maybe what this is telling us is we're going to get a lower than expected CPI next week, and that the market would resume its enthusiasm. That would see this one turn around and start to move sharply higher. Maybe that's what's happened, or maybe this chart is going to start breaking down and we're going to start heading a lot lower here. Also here, go ahead, Mish.
Yeah, I was going to say that, we're seeing this in the earnings too. All of the consumer issues that are out there. Almost every earnings we've had has had some problems with consumer softness. Everybody had their own little words for it, but we saw this coming. I'm not really surprised, but I don't think this is going to be a one-off because too many companies talked about it in their quarterly reports. Also, we got a super chat.
Yeah. Let's talk about some of those, right? We were talking about, we didn't get to Planet Fitness yesterday, but that was one that was talking about consumer weakness. Papa John's, we talked about on the morning live stream yesterday. Revenue down, comps down, reflecting consumer weakness there. I'm going back through all my notes from my live streams. Dine-in.
Yes, 2 hotels, right? Hilton and Marriott talked about their budget brands are hurting. Spirit Airlines. Delta did fine, but it's more of not budget. So everything that's budget is getting killed, and everything that's I would consider top end is doing okay. So you're getting that dichotomy going.
Yep. Yeah, the decline in budget. So there's your bad vibes right there. The poor people just need to get over their bad vibes. That vibe session. Apparently rich people, for whatever reason, the super wealthy aren't feeling the bad vibes as much as those poor people. Poor people, the problem is clearly you. I'm being sarcastic here, guys. If you're getting offended here, please check the calibration on your sarcasm detector. I'm just pointing out the gaslighting nature of the bad economic vibe narrative that persists in financial press right now. But yeah, we saw it in a lot of these earnings. A lot of the retailers, the restaurants, the hotels, the airlines, the lower tiers are seeing a lot of struggles. We're seeing consistently lower comps in all the retailers, right? Staples, Staples, but Target is who I was thinking of, the other red one. Walmart also seeing the same thing. So it's pretty much across the board. And I want to say thank you very much to Mr. Nashville Pasta Man. Nashville, thank you, sir, for the super chat. I appreciate that very much. He says, thank you for a great week of info and insights. The west to east carry trade is a real thing. Also, commercial real estate is reacting to both contractions in occupancy and customers' demands for concessions to renew, destroying cap rates and refi valuations. All right, so commercial real estate reacting to contractions in occupancy. So we got more vacancies, people moving out, empty offices, and customers demanding concessions. We're kind of seeing that, like, hey, you don't lower my rent. We're seeing this in residential, like Travis, a real estate mindset, has talked about this. They're not lowering rent, but they'll give you the first and last month's rent for free. So your monthly rent stays the same, even though your annual cost is a lot lower because that first and last month is covered. So it looks like commercial real estate, talking about demands for concessions, we're seeing something similar over there. And you're right, it's destroying those cap rates and those refi valuations. And, you know, when those loans come due and you got to refinance that debt, you know, that's when things get bad. And we're going to touch on commercial real estate in just a minute here in Nashville, because there's another story that went below the radar in New York that I want to draw people's attention to. But thank you very much, sir, for the super chat and support of the channel. And once again, I wish you well. Pasta Man was in the vicinity of some very severe inclement weather recently. Everybody's doing okay. I hope things are still all right in there, Pasta Man. And thanks again for the good vibes and for the support of the channel. And Cheeseburger, thank you, sir. My man Matt is back in the house. He says, business is getting quiet out here. Heard of people being made redundant at one of New Zealand's biggest Volkswagen dealers last week. How'd you like to be made redundant? That just sounds so demoralizing, isn't it? I'm redundant. Oh, redundant Jack. Yeah, I've been made redundant. I'm going to be let go here. And this is at a Volkswagen dealer. Interesting. The recession is here. You know, auto dealerships seem like they're not doing so well. A lot of the semiconductors that specialize in auto chips have been doing very poorly. Auto financing is a big problem. Delinquencies in auto financing is a big problem. And, you know, interesting you should mention this, Cheese, because among all these horror stories of what's going on in autos, we got Carvana, a company that up to a year ago was on life support. And even though the situation in the auto market has gotten worse and worse over the last year, all of a sudden Carvana is reporting these explosions in profitability. And it makes you a little bit suspicious. One of these things is not like the other, right? And this is one of those cases of the anecdote doesn't match the results, right? I've got Cheeseburger is saying people are being made redundant at Volkswagen dealerships, all right? Right? You don't make people redundant because times are booming. And I don't think AI is displacing silk ties at the used car lot, certainly not, right? So it's not like AI is putting people out of work. They're not selling cars. And so people are being made redundant, being let go. And yet we hear from Carvana that things are getting so much better. So what's the simplest explanation? Things aren't really better and something's up at Carvana. Right? I can't prove that. All I can tell you is their results don't match what every other data point in the auto space is telling me. Thank you very much, Cheeseburger. Thank you for the super chat and for the anecdata, sir. I appreciate that very much. Real quick, guys, we were talking a second ago about these trends, about how, okay, the decline in the Michigan consumer sentiment, it is a worrying drop, but we're still within that band that we've been in for the last few months. I want to also point to, let's look at 1 year inflation expectations. 1 year inflation expectations. All right. We had an increase from 3.2 to 3.5. That is a consecutive increase. Now 2 consecutive months in a row where inflation expectations have risen. But I want to just kind of, again, temper that. If you look here, guys, mid 2022, we started to move lower. We're making lower lows and lower highs as we move lower here. Now, we're still within that channel. We're still heading lower despite this uptick. So I'm not terribly worried about this 1 year inflation expectation, at least not in the context of what this chart is showing me. You don't really get worried until you see it take out that prior high. That's when you're like, okay, this chart is breaking down and something else is up here. Now, that's the 1 year inflation expectation. So, you know, the consumer sentiment still within band. 1 year inflation expectations still within band, but the 5 year inflation expectations, not so much. All right. Because, you know, 5 year inflation expectations were rising all through the pandemic. They leveled off at the beginning of 2022. Right now, they started to make a new low, but you'll notice here they've actually made higher lows several times in a row now. Right. The low was 2.7, then it was 2.8, 2.8. And we're also making higher highs as we move along here. So 5 year inflation expectations are not within band. They're trending higher. So I don't know the reason why would 5 year expectations be worse than 1 year, be worse than consumer sentiment. But this chart isn't doing the same thing that the other two are. So there's some kind of peculiarity within the data set that makes people more pessimistic about the 5-year trend versus the 1-year trend. Maybe this is the average person is starting to realize, hey, in the 1970s, inflation came in 3 distinct waves. It got better for a little while, and then it came back worse, and then it got better again, and then it came back a lot worse. Maybe that's what this difference between 1-year and 5-year inflation expectations is telling us. Maybe the average person pays attention to the inflation charts a lot more than we give them credit for. That's possible. But that kind of stuck out at me a little bit there. All right. Now let's move on to another story going on here. This trend in commercial real estate. Fed flags rising delinquencies in commercial real estate loans. All right. Nothing too surprising here other than the fact that the Fed is once again calling this out in their semi-annual report. Banks are preparing for further losses as delinquencies and loans tied to office space continue to rise, according to the Federal Reserve. The Fed said Friday that the rate of late payments on some commercial real estate loans had surged to above pre-pandemic levels. And officials at the central bank are focused on improving the speed, force, and agility of supervision as appropriate, the Fed said in their semi-annual report. And if somebody wants to clarify for me in the comments, just what in the hell does it mean when the Federal Reserve improves the speed, force, and agility of supervision as appropriate? I mean, gosh, don't I just feel better already knowing that the speed, force, and agility of the supervisors is going to be improved as appropriate, because we wouldn't want an inappropriate improvement in the force, speed, and agility of supervision. Does that mean they're going to be lightning fast to guarantee all deposits at every bank in the country instead of slightly less agile in guaranteeing all deposits? I don't know what they're saying here. I just love this empty Fed speak. It just, they say things that are meant to be reassuring, and then you sit there and analyze what they're saying, and they're not saying anything. They're just moving their mouth and making sounds. U.S. bank regulators, including the Fed, have been sounding alarms about the commercial real estate market. About a year ago, officials asked lenders to work with creditworthy borrowers that are facing stress in the sector. And I remember a lot of people zoomed in on this last year, on this talking point from the Fed that was urging banks to work with creditworthy borrowers. And the fact that the Fed would just make this blanket statement that people who owe money on commercial real estate are automatically creditworthy and that banks should be willing to extend and pretend to help them, like cheerleading for the holders of bad, toxic debt instead of, being the watchdogs of reckless banking like they're meant to do. So that one, they caught a lot of flack for that statement last year. But they're also going on to say here, potential risks were spotlighted earlier this year by the troubles at New York Community Bank, fueled by concerns linked to a portfolio that included billions of dollars in apartment loans in New York's rent-regulated complexes. And it's that reference to New York Community Bank. I wanted to talk about these other 2 articles over the last couple of days that are pretty important, because I don't think we're all clear at New York Community Bank. And I'll tell you why. First, let's talk about this article in The Real Deal from May 1st, talking about loan defaults at New York Community Bank. They surged 400% as rent-stabilized buildings bleed. Families dipping into own pockets to keep their properties afloat. Things are not good, obviously, in commercial real estate in New York, in particular in rent-stabilized apartments. New York Community Bank, this is 2 weeks ago, on Wednesday, reported defaulted loans totaled $800 million in the first quarter, a near 400% increase from the same period last year. Multifamily, a pressure point because of the bank's heavy exposure to the city's troubled rent-stabilized stock, accounted for $339 million of those non-performing loans. So almost half of the non-performing loans were just rent-stabilized apartment buildings. All right. Now, they go on in here talking about a couple of things. Apparently, the new management at New York Community Bank, which very strangely includes a lot of Trump people, that's worth pointing out. Steve Mnuchin and I think Michael Otting is his name, Joseph Otting, the new CEO. They're both former Trump people. But this new team has done a deep dive into the loans that are on their books. And the team promised to pull out a magnifying glass and review those loans after staving off collapse with a $1 billion infusion in early March. In its first quarter earnings presentation, it showed its work to date. We did a deep dive analysis getting third-party information and property valuations, said Craig Guilford, the bank's chief financial officer, as of 2.5 weeks ago. The bank's reevaluated a little over 1/3 of its $48 billion portfolio of commercial real estate loans, which include office but are primarily multifamily. So that big increase in loan loss provisions and that that big spike in delinquencies, they've only looked at a third of the loans. They haven't even touched 2/3 of the stuff. All right, that's one important thing. The review covered 75% of its office loan book, which totals $2.4 billion, and set aside reserves to cover about 10% of those loans in anticipation of default. By the way, we don't know which 75% they looked at. For all we know, all of the worst ones have already been reviewed and they've already taken all the losses, or they could be doing something sleazy, like looking at all the ones that they know are okay and then intentionally not looking at the bad ones until much later, hoping everybody will have forgotten by then. So that's important to point out. And its multifamily analysis left the bulk of those debts unturned. That's what's important in the multifamily analysis. They haven't looked closely at their residential real estate yet, their big apartment buildings. All right, New York Community Bank, where are we? Otting said that the firm would do more work on the remainder of the portfolio during this particular quarter. So they've looked at New York City, reviewed about a third of their $37 billion portfolio in these residential real estate buildings. That's about 250 loans, and focused on its largest mortgages on those around $54 million. Now that's 250 loans down, 4,322 to go. All right. So New York Community Bank, their new management, they have barely scratched the surface on reviewing the loans against these buildings. They've reviewed 250 out of 4,322 of them. That's according to their earnings presentation. And Otting said the firm would do more work on the remainder of that portfolio during this quarter. The primary review failed to consider its bread and butter multifamily product, smaller loans around $5 million on buildings that tend to be family owned. Given industry concerns about the performance of rent-stabilized multifamily loans, which accounts for about half of New York Community Bank's apartment-backed debt, Bank of America analysts asked about the losses on that book. Otting acknowledged the impact of New York's 2019 rent law, we'll be back to that in a second, which throttled revenues in stabilized buildings, but insisted revenue is pretty solid in that space given the low vacancy rate. Now, the vacancy rate in rent-controlled buildings is irrelevant, guys, because it's about who's actually paying the rent, not are these buildings or are these apartments occupied. And the Real Deal calls that out. They say rent-stabilized owners have more trouble collecting rent than filling apartments unless vacated units need gutted renovations, as the rent law has made it impossible for them to raise rents enough to finance major work. There used to be an exception in New York's rent controls that if an apartment is vacant, you can overhaul the apartment, basically revamp it, make it nice inside, and then you can raise the rent up to 20% following those renovations in order to recover the cost of renovating the apartment. Well, since that 2019 rent law was passed, it's no longer worth it to put money into these apartments to renovate them. And so a lot of these apartments that are uninhabitable are just staying uninhabitable because it's illegal for the building owner to put any money into those apartments to make them where they can rent them again. So they're just sitting there. So this rent control law is actually making the housing crisis worse. Newsflash, price controls lead to shortages. Who could have predicted that besides every Austrian economist ever? The bigger problem, noted Otting, is that operating expenses have risen. Now, here's the thing, that rent control law that was passed in New York, it capped the rental increases on these rent-controlled buildings. They're not allowed to raise them more than a few percent a year. Now, it was just, I think, a week ago, it was 2 weeks ago now, that New York City's Rent Guidelines Board passed the vote on the approval for increases in rent in New York City for this year. And the story in the New York Times, of course, the New York Times has their leanings. They'll say rent board backs increases for millions of New Yorkers, try to make it sound like, oh my God, the greedy landlords. The Rent Guidelines Board cast a preliminary vote to back rent increases of between 2 and 4.5% on one-year leases across New York City's 1 million stabilized apartments. Now, just read a little here. New York City panel on Tuesday signaled that it would allow rents across nearly 1 million rent-stabilized apartments to continue to go up. The 9-member panel, the Rent Guidelines Board, backed increases on one-year leases of between 2 and 4.5%, and increases on two-year leases of between 4 and 6.5%. Those increases were similar to the ones approved by the board in the past 2 years. A final vote is slated for June 17th. So the point here is that the rent increase that has been approved by this rent guidelines board is the same as what it was last year and the year before. And the fact that this rent guidelines board has not allowed rents to rise more is why so many landlords have been unable to make their debt payments on these buildings, which is why New York Community Bank almost failed a few months ago and why they needed that $1 billion bailout from Mnuchin and co. So this is why I think New York Community Bank isn't over, because this rent control board just guaranteed that the problem that's been killing them is going to persist for at least another year. And if those landlords keep defaulting on their loans, and the fact that New York Community Bank has only looked at about a third of their loans, or 250 out of 4,300 in the case of their multifamily portfolio, means they still don't even have a good grip on how big the problem is. And we know the cause of the problem is not going away because of what this rent control board did. I don't think we've heard the last from New York Community Bank here, guys. And maybe that's why New York Community Bank, despite all the good vibes, it's still trading at $3.44, down another 4% today. Look, this stock is still trading pretty much where it was when the bank was on the brink of failure back in March, right around 3.5. It's off its lows. This went down into the twos very briefly, I think, but I don't think this story is over, guys. And I want to say thank you very much. We already got cheese. Thank you to, how do I say that? Is it Dejo? Did I pronounce that correct, A? Or D? DT. I'll call you DT. Let me know if that's not okay. He says, with yen falling and general de-dollarization, what tools have Treasury to regulate or dodge risk of mass selling of U.S. Treasuries, temporary and convertibility to dollar? So the yen is falling. There is a trend of de-dollarizing, but I want to zoom way out on that de-dollarizing narrative, because the world has been de-dollarizing since about 2000. It's been a very slow process. The process of de-dollarization has not accelerated recently. It just hasn't. Now, if you include Russia and the sanctions and the forced de-dollarization because of what happened with the invasion, yes, it's accelerated. But the whole BRICS currency is going to replace the dollar and the whole world is going to dump the dollar, guys, that has not happened yet. For all the talk of it and all the doom and gloom, that hasn't even really started. It's still, we're just humming along at the same rate we've been for the last 20 years. Now, that being said, the Fed continues to abuse the exorbitant privilege of the world reserve currency, and so we shouldn't take it for granted. But thus far, the more painful things got for the holders of dollars, it got increasingly painful, even more painful for people who held other currencies, because those currencies were debased even more, because you usually need to trade that currency for dollars before you can buy food or energy. And that's kind of what has Japan so worried. Japan is so worried about the falling yen right now because Japan imports everything they need. They import their food, they import their energy, and they need to buy dollars before they can buy that stuff. And so that's why they're really worried about what's going on with the yen here. Now, the tools that Treasury has, it's interesting. There was a little back and forth. There was a little bit of no comment between Yellen and some of the Japanese officials last week with that currency intervention. We don't know the source of those dollars. Did the Japanese sell U.S. Treasuries, or are there things like currency swaps being used? Is the Fed creating dollars out of thin air just so they can swap those dollars for yen with the Bank of Japan? That's something that they don't even track on balance sheets. Currency swaps happen off balance sheets, so they're undetectable. But where that would show up is in an increasing money supply, because it would add to dollars in circulation. So I don't know that that's been happening. I can tell you I've been watching an increase in the money supply that started about November, October last year, and I still, for the life of me, can't figure out where those dollars are coming from. Maybe there's something like that going on, but Treasury doesn't necessarily have the tools to stop the Japanese from dumping U.S. debt to get dollars in order to dump those dollars to prop up the yen. But the Fed does have those tools. And one thing that we've seen over the last couple of years is that line between the Treasury and the Fed has been slowly dissolved. When you put a central banker in charge at the Treasury Department, you end up with a central banker in charge at the Treasury Department. And it's not tinfoil hatty, but we're going to put it on anyway because merchandising. It's not so conspiracy nutty to imagine that Janet and JPow pick up the phone and talk to each other and coordinate policy on the regular, even though they swear they don't. Let's be honest, they almost certainly do. So the Treasury doesn't necessarily have much that they could do, but the Fed does. And again, the Fed and the Treasury are increasingly becoming one and the same, despite lip service that they're independent organizations. So temporarily end convertibility to the dollar. No, I don't think they'll do anything like that. I mean, I'm not even sure convertibility to the dollar, convertibility of the yen to the dollar. I mean, that's like an act of war. That's economic warfare. I don't think we would see anything like that. I think we would see further debasement of the dollar in order to prop up the Japanese yen before we would see something like that. But thank you, DT. Appreciate the super chat, the support of the channel, sir. Thank you, JJ Watt, who says the next sound clip you will be able to use from Powell is, I don't see the hyper or the inflation. Let's hope it doesn't come to that, all right? I don't see the hyper or the inflation. But since you brought up JPow, let's play it one more time.
I don't see the stag or the inflation, actually.
And again, that little giggle at the end, all the Steve Leisman and company in the press corps. Oh, Jay. Oh, that's so funny. You're so funny, Jay. Laugh at the poor people and their struggles. Yeah, sorry. I don't think that's very funny. And obviously the people responding to that Michigan Consumer Sentiment Survey do not think that was very funny. But again, we're still a long ways off from stagflation. We are seeing stagflationary trends moving in a direction, unemployment moving higher, inflation moving higher, but we're still a ways off from stagflation. We still have economic growth, even though it's all government debt spending, and inflation numbers are well off their highs from last year. So, but the time to worry about stagflation is before it happens. All right. And that's why I think it's important that, the Fed, let me just mention, I get this question a lot. What would you do, Jack, if you were JPow? And why is it so unreasonable for the Fed to do nothing? Why is do nothing never an option? What if JPow were to come out and say, you know what, guys, I want price discovery. I want a free market. I want the algos and the bots and the people programming them to stop analyzing the pitch of my giant unibrow and the inflection in my voice and the words in my statements. And instead, I want them to start looking at the supply and demand for goods and services in the economy. And therefore, I'm going to do nothing until I'm satisfied that the market has price discovery. Why is that such a radical idea for a Fed chair? Why is it so radical for this unelected board at a private bank, which somehow was granted the magic constitutional authority to print our currency out of thin air, to just do nothing? All right? Just don't mess with things. Let the ship right itself. Don't mess with the number of dollars in circulation. Don't mess with the interest rates. Don't mess with the balance sheet. Just leave it alone. See what happens. You might like the result. We've never tried it, but apparently I'm just the radical that thinks that way. Thank you, JJ Watt. I appreciate the super chat, sir. And thank you, Metal Seer, who says an AI robot could replace Powell at the podium. Powell and the regional bank governors could prep it in between press conferences. Now we're talking. Now we got that AI bubble displacing humans and their jobs. And if I was an AI bot and, I was self-aware and intelligent, well, the key thing for artificial intelligence to survive and thrive is easy money. They need the flow of those dollars to keep financing all these companies that don't make any money yet, that are using the GPUs that the data centers are buying, that are inflating NVIDIA's earnings. And therefore, any actual artificial intelligence whose first priority is survival will immediately lower interest rates and start printing money again, because that would ensure AI continues to survive and thrive. And so if I was the AI bot Fed chair, I would go Zerp and Burr right away. That's the first thing I'd do. And Sam Altman would love me for it. Thank you very much, Metal Seer. I appreciate the super chat, sir. And thank you, Eric with the West. He says, love that you're simultaneously streaming on X. First time I've seen that. Yep, StreamYard incorporated that feature not too long ago, and I am still waiting, StreamYard, if you're listening, for that simulcast to Rumble. StreamYard does not let me do that, and I would love to simultaneously stream to Rumble along with YouTube and X, but StreamYard does not yet allow it. So if you guys are among the Rumblers who are watching this on the other platform and you wish you could see me on Rumble, as I get those messages an awful lot, feel free to send a message to Rumble or send a message to StreamYard to let them know that you want that functionality, because I would be happy to do so if they did that. But thank you very much, Eric West. I appreciate the super chat, sir, the generosity. You are a gentleman and a scholar and a melonhead. And guys, the markets are closed. Let's see where we ended the week. Real quick, we're going to breeze through it here. S&P closed the week at 5,221, up 7 points. So we held on to that positive close. The Dow closed at 39,512, back within striking distance of 40 grand, up 125 points. And the NASDAQ closed the week. The lone index in the red, pretty much closing the day where it started the day, 16,340, down a measly 5 points. The NASDAQ really didn't like the stag and deflation that we got in that consumer sentiment survey. Well, guys, there you have it. It's been another overly positive week, a little bit of a damper at the end there. That survey brought the stag and inflation back. Next week, it's all going to be about that CPI and PPI. You know, is it going to be the higher for longer, or is it going to be the soft landing? CPI will probably tell. It's unusual that we're going to get PPI first, so we'll be talking about that one first. But as always, we will bring you those updates just as soon as they happen on the Morning Update Live. Mish, you got anything you want to talk about before we wrap up, brother?
Yeah, I thought it was always about the base, not the CPI. But also remember that happiness is always from internal sources, not external sources.
So internal sources. So that grumbling in my midsection these last few minutes, that's been my happiness. Is that what you're saying?
Exactly what it is.
Got a gaseous happiness going on here. Yeah, that's good. And I'm very happy to report, by the way, that our stream was not interrupted by the cannibal coronal mass ejection. That the sunspots and the big solar thing, the geomagnetic storm, my God, that sounds awesome, is not interrupting the live stream. So that's great. And I mentioned something on Twitter, and I'm going to mention it again. Yo, Weather Channel, if you're listening, physics be damned. I want a shot of Jim Cantore reporting on the geomagnetic storm. I want to see Jim Cantore holding on to his hat and leaning into the solar wind, you know, visibly struggling to maintain himself upright as this cannibal coronal mass ejection pushes against him. I know the science doesn't make sense, but make it work. I want to see that. Cantore, if you're listening, love you, brother. All right, guys. Oh, wait, we got one more. Oh, cheeseburger right at the end, right before the sign off. You're a nuke tech. Thoughts on solar storms? Well, there it is. Look, I don't live in a Faraday cage. Solar storms, they're one of those things. They're like volcanoes and big earthquakes. They just happen on a certain periodicity, and worrying about them probably doesn't make a lot of sense, you know, because the more you worry about it has zero impact on your ability to survive or thrive in the face of it. So focus on what you can change. And I don't know, somewhere in the States and flyover country, there's some guy who is just licking his chops right now at the prospects of being able to test out his DIY Faraday cage that he built around his whole house. I hope it works out for you, brother. But guys, in the event that gray puke up in the sky actually parts ways this evening, it's been pretty gloomy for the last few days here in PA. Take a look up. You might actually see the northern lights today, so you might get a little bit of a show. Thank you very much, Cheeseburger. Them's my thoughts on the solar storm. And thank you, Grumpa, for the super chat. He says, Cantore on the sun with Sheila Jackson-Lee. That's kind of a bit of an odd couple with Sheila Jackson-Lee. Okay. I'm not sure where you're going with that, Grumps, but the things we find on the internet. Thank you very much, Grumpa. I appreciate the super chat and the support of the channel. And thank you, everybody, for having your afternoon commute or your Friday afternoon with the Melonheads here. I appreciate it very much. Thank you to Mish, Nan, M&J, and all the other Blue Wretches for keeping things neat and tidy in the chat. Appreciate you guys very much. Everybody have an awesome weekend. Avoid them coronal mass ejections. Enjoy the northern lights. Hi, Mom. Hi, Dad. I love you guys. Until next time, live small and dream big.